Many practitioners with an advanced knowledge of estate and gift taxes may not have corresponding knowledge of the same depth when it comes to income tax and loss rules. But that may become important, especially if there's a loss in the step-up in basis, because that loss of the step-up in basis will disproportionately affect ordinary income items such as recapture that would incur on the sale of a depreciated asset. So, special attention will need to be given in areas such as planning under buy-sell agreements or planning for loss harvesting within entities, but with a nod to the possible preservation of capital losses or ordinary losses if that's allowed. Of course, one must question whether a loss of the step-up in basis will also allow for a reduction or elimination of the step-down in basis that exists under current law for assets whose estate tax value is less than their carryover basis. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 195, we're going to really go surface level and kind of skirt some back of the napkin ideas I had with respect to basis step-up and depreciated assets. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to our presentation. So, as we all know, if you've listened to these episodes in the past or followed tax news, there's been, as part of capital gain reform, quote unquote, a proposal to eliminate the step-up in basis. The problem is that the two don't necessarily go hand in hand. If you're looking at capital gain reform only and you want to eliminate the step-up in basis, you have to note that it's also going to affect ordinary income items. Because really what the step-up in basis and the capital gain reform are concerned with are long-term capital gains. But those are completely invalidating or dismissive of the fact that the step-up in basis also can eliminate, one, short-term capital gain for assets that are held for 1 year or less. Now, that's kind of moot in the estate world because the step-up creates a long-term capital gain automatically, or a long-term capital gain holding period for any assets with a stepped-up basis. But it's important to note that short-term capital gain is ordinary income, but it's special in that you can net capital losses against it. Now, ordinary income is taxed at ordinary income rates, and a lot of times this reflects recapture of adjustments to basis that come from deductions for things like depreciation that we'll look at in a minute. And you can't net capital losses against that usually, unless you're an individual, and even then you're limited to $3,000 in capital loss deductions every year against that ordinary income. But the step-up in basis does eliminate the recapture, at least up to the deflection point of whatever the fair market value of the depreciated asset might be. Now, it's important to note that some ordinary income may be income in respect of a decedent, so it kind of stays the same. It's tax neutral. It's not affected by the step-up in basis or loss thereof. But the big question here is whether any reform for a step-up in basis will or should take into account ordinary income, and instead of being tax neutral, instead look at the character of income that's affected by the loss of a step-up in basis. Now, for many assets, especially ones that are used in a business, there could be ordinary income on a sale due to the fact that deductions for things like depreciation or amortization or depletion were taken by the decedent during his or her lifetime. And those deductions are usually reflective of reductions to basis that come from those types of income tax deductions. So because these deductions reduce basis, there will usually be a much lower basis at death, which could be stepped up. But it's important to note that these deductions really originally were designed to represent wear and tear and the reduction in value of an asset that you gain from the fact that it has a limited lifetime or useful lifespan. So since these deductions represent wear and tear, ideally they should also concurrently be reducing fair market value, which will reduce the estate tax that's ultimately payable at death. Now, the tax effect here can't really be examined in a vacuum. We have to look at the delta for both the basis and the fair market value that comes from these cost recovery deductions. So, with the step up in basis or loss thereof, you have to look at the fact that if the change in basis is greater than the change in fair market value that comes from those depreciation deductions, that'll have a negative tax effect. But if the change in basis is less than the change in the fair market value, which is rarely the case, but could be the case, then there's a positive or even neutral tax effect. But a lot of the effect hinges on the question of whether or not there could also be a step down in basis in that sort of situation, even if the step up in basis is lost. I'll address that briefly at the end, but where this really comes into play is within entities themselves. And there is no way I could even get beyond just scratching the surface on all of these various rules. So I'm going to assume you have some knowledge on the partnership and corporation side, and if not, this will tell you what gaps you might have in your knowledge that you need to look at. Now, within a partnership, depreciation recapture is important because that's a hot asset, which is treated as cash in any sort of partnership interest redemption or liquidation. Now, within a partnership itself, right now there's a 754 election available, which allows you to shift the outside stepped-up basis in a deceased partner's interest to the inside basis of partnership assets, including hot assets potentially, in an ordering regime, but that's going to be lost if the step-up in basis for assets in the estate goes away. Now, for one, in a buy-sell or similar agreement, that's going to disproportionately affect partnerships and entities because this will create gain recognition to the estate, with a caveat that we're going to look at in a second with corporations too. But in any sort of partnership liquidation or redemption, it's important also to note that this could also generate gain to the estate, which goes away or is enhanced here, I should say, because what you do in that redemption situation is you look at cash and hot assets and partnership debt relief, which is also treated as cash, and look at whether those exceed the estate's carryover basis, and that would create a gain in this situation. Now, I'm going to emphasize the estate's carryover basis because that's going to be the rule with a loss of step up, and it's going to increase the likelihood of a hot asset triggering gain in the form of ordinary income on the redemption of a partnership interest. And if not, then those cash items are going to reduce the basis of other distributed assets because whatever basis is left of the carryover basis in the partnership is really going to be assimilated into the basis of distributed non-hot assets in that partnership liquidation or redemption. Now, within corporations themselves, everybody talks about general utilities. I'll get to that in a second, but I want to emphasize again too here with a buy-sell or stock redemption type of agreement that although the stock is a capital gain asset, there would be gain to the estate potentially. And I know we're not talking about capital gains in this episode. We're talking about ordinary income, but I want to emphasize there's a mismatch here potentially that could come into play. One is that there's a code section 2703 where when there's substantial family ownership of an entity, it disregards the redemption price in a buy-sell agreement or the purchase price and instead uses the fair market value of the stock or interest as the basis for the estate tax. Now, 2703 is an estate tax rule only, so the effect is that it might limit or increase the step up in basis if that applies. And obviously, if the step up in basis goes away, that could give us more room to play with the section 2703 value within an intra-family buy-sell agreement. So maybe you could use a redemption price that's deflated low, and even though it's not going to be respected for estate tax purposes, maybe it could be respected for income tax purposes, especially because there's no step up in basis for the stock. So the big limitation there might be related party issues in claiming a loss on the stock, which would be a capital loss, but it's something to think about in the grand scheme of things. Also, I want to emphasize with a corporation, we have the general utilities doctrine, which treats a distribution of appreciated property from a corporation as a deemed sale, but it only applies to appreciated property. It does not treat the distribution of lost property as a sale. So the big question here is, could there be loss harvesting by distributing lost property from an S corporation to the shareholders? Now, I emphasize S corporation because that wouldn't be a dividend distribution then, whereas in a C corporation it would. But you could harvest this loss by distributing that lost property that has a higher basis than its fair market value, and then allowing the taxpayers to claim a loss, or the shareholders to claim a loss on an economic sale of that corporate property, maybe to offset the effects with the buy-sell agreement, or even to offset some of the estate tax that might result on the entity through Code Section 2703, especially in an intra-family ownership situation. Now, another thing to keep in mind too is that with basis allocation, I've seen some people ask the important and relevant question of whether the limited basis adjustment like we saw in the year 2010 under Code Section 1022 might come back. And if so, will it be changed? Will there be any sort of ordering rule within that? Because ideally, this could give you some room to play around. You could preferentially allocate that basis step up to appreciated property over lost property, and within that appreciated property, you could preferentially allocate it to ordinary income items over capital gain items, and obviously maybe to allocate to lower basis items as opposed to higher basis items, looking at the carryover basis. So the big question would be, right now as we're drafting, should we be considering giving executors or trustees the discretion to do so in documents? Now, that may not be available ultimately, but it still might be something to keep in mind, and it may already be in documents in form if you have, for example, a document that harvests a basis step-up with a formula general power of appointment for a beneficiary. Same language could have double purpose, even though that language becomes moot with a loss of the step-up in basis. It could have some utility if there's this limited basis adjustment as well. But if the allocation ends up being pro rata among assets, like you might see in a 754 election for a partnership, obviously this all becomes moot. And finally, for preservation of loss, it's important to note that you can't bequeath or gift a tax loss, because the gift and estate taxes apply only to the fair market value and not to the loss portion of the property. So for example, if you have upside down property, it gets a step down in basis at death right now. So the question is whether this will and should be preserved. Intuitively, it seems if the step up in basis goes away, you should also get rid of the rule mandating a step down in basis, which would preserve a loss for the estate or the heirs, which obviously you have to balance with any sort of deduction or tax benefit you get to take into account the loss of the step up in basis, like in Code Section 691C. Looking at the estate tax that's generated by that item. So with an upside down property, you might have some sort of concurrent opposite type of thing that limits the ability to claim that type of loss. But like I said, this is all spitballing and we have no idea what's going to ultimately happen. But for the time being, I'd say it's important to brush up on your knowledge of income tax and loss rules if you are an estate planner, if you work in this area. As always, if you have questions or topic suggestions on non-client related matters, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.